The Fed leaves rates unchanged, but what's to come? I'm Lisa Bernhard with Reuters. Let's ask Eric Diton of the Wealth Alliance about the Fed and a lot more. Eric, not a huge surprise, right? Rates were left unchanged today, but the economy certainly has not slowed down the way, I think fair to say, the way the Fed thought it would. So is another rate hike on the table at some point?
So is another Fed hike on the table? The Fed has made it clear that they're leaving that open. However, I don't think it's happening this year, simply because the markets have done the Fed's dirty work. What I mean by that is that longer rates, the 10-year has moved up a good 1% in the last few months. We hit 5%, which we haven't seen since 2007. That's a major tightening of credit. And that in and of itself can slow the economy. That allows the Fed to kind of sit back and watch. And that's what they're doing.
So describe just in very layman's terms for folks, what exactly in this climate drives that yield up?
So what's happened is the markets have been talking about a possible recession now for a year, that elusive recession that refuses to happen. And we have just come off of an incredibly strong quarter. The US had GDP of nearly 5%. That is off the charts. Granted, some of that was from a lower than normal savings rate, but the bottom line is it's a big number. And what that means is when the economy is strong, companies are growing, they are hiring, and they need credit. And that demand for borrowing pushes up interest rates.
When we look at stocks, the talk at the beginning of the year was the big run up in the S&P, NASDAQ led mainly by the Magnificent Seven, mega cap companies. We've hit a bit of a correction. It's now November 1st. Talk to us about what we're seeing right now at this moment in time in the markets and what you think we'll see through the end of the year.
So this is just a highly unusual year. As you said, a very, very narrow advance. The biggest stocks in the S&P made the biggest moves on the upside. And so what's interesting is almost every major index is negative for the year. People don't even realize that. If you look at small cap stocks, down, mid cap down, international down, emerging markets down, the Dow slightly negative. The S&P is still up 9% because of that Magnificent Seven. And the NASDAQ is up about 18%, although interestingly, the last 3 years, NASDAQ's annualizing at 5.4% a year. That's how bad last year was. But the bottom line here is the equally weighted S&P. How did the 500 stocks do? They're down 4% year to date. That is a 13% differential between the market cap weighted S&P and the equally weighted S&P. When did anything like this happen last? 1998. And the next 5 years, the market cap weighted S&P had a negative 5-year return, and the equally weighted S&P was up nearly 7% per year. When is that change going to happen? I'm not sure. But the point is, maybe those big tech stocks have just gotten expensive and need to kind of get back to the mean. And there's a whole bunch of unloved, cheap stocks out there that maybe deserve to be scooped up right now.